welcome to Bloomberg Quint. You're watching BQ Conversations, and we're in conversation with Seah, Chairman of DBS Group, and Piyush Gupta, CEO of DBS Bank. Thank you both so much for speaking to us here on Bloomberg Quint. I'm going to start with you, Mr. Seah. We are here at a time when the Asian infrastructure investment banks conference is going on, and I think you would have attended some of the sessions. We came away, like we do from every conference around India, saying that India has great investment potential. But over the years, we've never seen the money match up to the potential. I'm curious to know how you view India right now, both the potential and the reality.
Well, I think with this huge population, and the GDP growing at 7.3%. India has great potential, and I think as it opens up, right, there should be more investments coming into India. Infrastructure clearly is one of the more attractive areas for investing in India.
And that philosophy follows through into what DBS Bank is doing here, and I'll speak to Piyush a little bit more about the specifics.
Well, DBS is the Asian-focused bank. And among the great geographies in Asia, India has to be one of the most important. And so we're here for a long-term presence. We're very happy that we have approval to have a wholly owned subsidiary. So our intention is to build a huge franchise in India.
Mr. Gupta, let me come to you on that then. So we know that the approvals are in place for the wholly owned subsidiary. Where are we on the process?
Well, let me first just add to Peter's comments. I think it's instructive that we are perhaps the only meaningful foreign bank to have applied to incorporate and subsidiarize in India. And the reason for that is we really believe in the opportunity of India, and we take a long view. So we recognize that the cycles in which it's more difficult to grow. Indian banking sector is going through a tough cycle right now. But if you have a 10-year vision or 20-year vision, then you just cannot fail to appreciate the promise of the Indian opportunity. Where we are in the process right now, when we got our in-principle approval last September, we had suggested that it should take us about 12 months to really hit the ground and start rolling out. We are on track. So we incorporated the company early this year. In the next few weeks, we should hopefully get the license for the new company. We have submitted a scheme of amalgamation to take our old business and amalgamate that with the new company. We expect to have that approved in the next few weeks as well. We've already submitted approvals for a new board. That's also relatively imminent. So we are quietly confident that in the September-October timeframe, we should be in a position to start actually launching our new expansion.
Mr. Gupta, when you came in, there was a troubled period, even for DBS. I mean, I think some of your bets didn't pay off. Then it seemed like you adjusted more towards a retail-driven strategy. As you become a wholly owned subsidiary, is that the focus? Are you going to be 50% retail, 70% retail? What's the plan, sir?
Actually, our plan is to dial up not just retail, but also SME. If you look at the nature of DBS around the world, a large part, we're about 50% retail, about 20% SME, and about 30% large corporate. In India, we're 70% large corporate. So this is not consistent with our profile in other parts of the world. And the reason for that is that to do SME and retail, you need to have presence. You need to be able to distribute. Part of the answer is in digital, which is what we're trying to use to get some expansion in the low end of the SME and retail. But digital cannot stand by itself in a country like India. So you have to support the online with the offline. And our hope is that with the post-subsidization, we can do that, support the online with the offline. Over time, if we can do that, then there's no reason why our income profile should not replicate what we have outside of India, which is a much larger retail and SME business to complement the corporate banking that we do.
So you won't shun large corporate lending in India?
You can't shun large corporate lending because that's an integral part of being a bank. And frankly, there's some important linkages that come from large corporate, going down the supply chain to the SMEs, working with large corporate employees. There's other thing that we can do with large corporate which plays to our strength, which is help in their expansion internationally. So when large companies go out, we are a natural partner with them. So there are clearly some good opportunities in the large corporate space. But I should also hasten to add that large corporate pricing in India is relatively mispriced for credit risk. So you have to find the right opportunities that can give you a competitive return.
So would you say lean towards, working capital more than you would say project finance? I think, again, coming back to the Asian Infrastructure Investment Bank Summit, it's a big question to us as to who the next round of project financiers in India are going to be, other than the state banks, which will probably do it, with a little bit of arm twisting. Is the DBS group going to do project financing in India?
We are open to doing projects. We have actually. We financed renewable projects in India. We financed a toll road in Jammu in India. But around Asia, we are very active in project finance. We've been voted the #1 project finance house in Asia for the last 2 years. We are currently doing financial advisory on 6 Belt and Road projects. We are doing 16 renewable projects around the region. So we're quite active in the project finance space. And we're not shy of looking at that area, but the project must be well structured. The offtake arrangements, the PPP arrangements, the documentation, the degree of confidence you have in policy continuity and regulatory continuity through regime change, that requires some degree of bolstering and a track record. But with those in place, there's no reason for us not to look at that as well.
What is your degree of confidence in India, in the track record in India, and policy risk in particular? Sir.
So I think in recent years, you're beginning to see some degree of policy continuity. I was with the Minister Goyal yesterday, and he made the point that there'll be no policy reversals by the new administration. Everything has been a build-up on the policies of the old administration. But the reality is that the markets look for much longer track records. So you have to see 2 or 3 regime changes, and you have to see consistency over several regime changes for the market to just rely purely on a track record. In the meantime, what investors tend to look at is how you can actually get some degree of additional risk cover, either through partly sovereign risk mitigation, or through the multinational development agencies, or through export cover, and how they can package a degree of political risk, policy risk, some degree of commercial risk cover. By and large, most of project finance in the region is bank-driven. And I think it will continue to be bank-driven in the foreseeable future because capital markets investors are very unwilling to take the first 3-4 years of construction risk, of pre-cash flow risk. So the banks need to come in at that level. Once you have cash flows in a brownfield project, you can flip it to the capital markets. But you will need bank presence to do that. But banks do need to, therefore, get that incremental degree of risk mitigation in several cases.
Mr. Seah, how does India compare on this policy risk front to other Asian economies that DBS Group operates in?
Well, I would say that India is quite typical of most emerging markets. There's always policy risk. There's always sovereign risk, but we see India moving the right direction. We see India becoming a more and more attractive market. So we are quietly confident, as Piyush says, that over time that would give investors and lenders their confidence, to engage more in India.
Mr. Gupta, on the retail and the SME front, tell me how you're approaching these two markets, because again, we go in waves in the Indian banking market right now. Everybody wants to do SME, everybody wants to do retail, and I understand it's a large market, but surely there were troubles with that market, which is why other people didn't, or everybody didn't rush into it earlier.
Well, first of all, the main troubles with the market come in down cycles. Both retail and SME tend to be very positively correlated to GDP cycles. So at some stage, the GDP will fall off and you will see a lift in delinquencies and provisioning. If you want to play in that market, therefore, you must be willing to go through cycle. Right? And so that's a key requirement, that you will recognize that there will be some down cycles and up cycles. You must be a long-term player. We believe we are, because we operate in these conditions in several countries. And because of the nature of our shareholder constitution and our board, we really tend to take a very long-term view of the future. In our own experience outside of India, we are doing two things. One, we have a lot of experience in both the consumer space, unsecured and secured, as well as SME. And so we will bring many of our underwriting knowledge and experiences to bear. But we are supplementing that again with data. So I think one of the big differences as we go forward is that data can bring transparency to cash flows and capacity that you did not have before. Already things in India have improved in the last decade with the credit bureau. So, if you look at the 07-08 problems, that was pre-bureau. You don't have the same situation anymore because you do have a strong bureau. But on top of that, being able to use incremental data, GST data, for example, the tax information, or just data from other banks and get a transparency around genuine receivables and payables, that allows you to underwrite with a far greater degree of sophistication than you could in the past. Now, again, we are doing a lot of this outside India. We've been rated the world's best digital bank a couple of times, and partly it's in recognition of our ability to use our digital assets differently from other banks. So we hope to bring that capability to bear in India as well.
That issue of mispricing of risk that you were talking about on the corporate side, has that not filtered through a little bit into retail as well as the market has become more crowded?
Actually, we don't see that. We think the risk-reward pricing in the retail and the SME side is a lot more sensible, even at this point in time.
Okay. And the segments of the market that are most attractive to you, would you say on the retail side stay in urban mostly? Or is there a recognition that urban is now over and done, not over and done, but fairly saturated? So you need to go into tier 2, tier 3, maybe even below that?
I think our segmentation on the retail side is recognized by the fact that we're still principally digital, with the offline being an adjunct. And since you're principally digital, your segmentation selects itself. People who can own a smartphone and can deal with this. Now, that's a growing segment. It used to be 120 million people. It's now north of 200 million people. But by definition, it is unlikely to be deep rural India where the smartphone penetration is still somewhat limited. On the SME space, we hope to be present in the 80, 100 big SME clusters around the country, and they're sort of well identified and well known.
Okay, just last question each to both of you. Mr. Gupta, I have to get a view from you on what's happening in Indian banking. We've got large, stress still sitting on public sector banks. We've got governance issues in private sector banks. I'm curious to know how an outsider sees it because, from the inside we tend to be fairly critical of what's happening right now.
I think I'm going to echo what Peter just said. This is not, different from many other emerging market stories. The reason emerging markets are emerging markets is because you go through these cycles and you have to go through a process of cleanup. The two things you talked about are a little bit different. On the portfolio quality issues, some of them were cyclical, some of them were self-created. I think a large part of the portfolio issues are infrastructure and EPC. Some of that is because both the policy frameworks and the execution led to long lead times, land acquisition, environmental clearances, etc., etc. But some of the issues were also reflective of the nature of our banking system, i.e. the independence and independent judgment, particularly in respect of credit, has not always been there in the past, especially in the public sector. Now, those are things that are being corrected with the banking bureau, with greater independence, with trying to get separate execution, this thing. But it takes time to filter through the system. The control issues are a separate set of issues, and corporate governance issues. I think, honestly, to my mind, they are symptomatic of a bigger malaise in the entire system, and I think it's the entire subcontinent, where this sense of good corporate governance has not taken root as much as it needs to. But again, this is not dissimilar to other economies. You take a look at the US, till even the 1920s, it was the day of the robber baron and the corporate thing. You take a look at many other developed countries today. They weren't born with the best corporate governance systems. These take time to fall into place. To my mind, where India is today is actually where some of these institutional arrangements, where the soft infrastructure and good corporate governance is actually beginning to get put on the table. So I think we will benefit from it in time.
Mr. Seah, last question, and sorry, I'm switching topics a little bit here, but I'm curious to know how you see the overall Asian economic environment right now. Apart from the fact that a rate cycle has turned, currencies are under pressure, there's the specter of trade wars which is hanging out there. A slightly tougher year than we've been used to in the last couple?
Well, I think Asia remains probably the most attractive region in the world in terms of for investments, for trade, and for banks. Clearly, as the emerging economies mature, like China, growth rates come off, But I think the opportunities are enormous. You don't only have India, China, Indonesia, you have ASEAN, 600 million people. So opportunities abound. The trade war, obviously, in the short term is negative, but I'm confident it will pan up somehow. Rationality will return. Trade wars are not good for anybody. But I think for DBS, we hold the view that Asia continues to be the most attractive region to be in. And we feel that just staying in Asia and making the most out of it would give the bank a tremendous journey.
Thank you both so much for taking the time to speak to us.
All right, thank you.
Thank you.
Thank you.